Hey, everyone, my name is Lucas, and if you're like me, you've probably wondered, what's the best way to make money in the stock market? Some people swear by trading, buying and selling stocks daily, making quick profits. Others say the real wealth comes from long-term investing, holding onto stocks for years and letting them grow. But which one actually works? Today, we're going to put both strategies to the test. We'll create two fictional portfolios, each starting with the same amount of money. One will follow the trader's approach, constantly buying and selling based on short-term price movements. The other will follow the long-term investor's path, holding on to quality stocks and letting time do the work. By the end of this video, we'll compare their results and see which strategy makes more money. Before we dive in, make sure to subscribe because we're all about helping you grow your wealth with smart investing. Now, let's set up the experiment and talk about the rules. To make this experiment fair and realistic, we need some ground rules. We're starting with two identical portfolios, each with the same initial investment. One will be managed by a trader, constantly buying and selling stocks, aiming for short-term profits. The other will be handled by a long-term investor, who carefully selects solid companies and holds onto them for years. But before we jump into the action, let's clarify what each strategy really means. What does a trader do? A trader actively buys and sells stocks, sometimes multiple times a day. The goal? Profit from short-term price movements. Traders rely on technical analysis, looking at charts, patterns, and trends to make fast decisions. There are different types of traders: day traders, who buy and sell within the same day; swing traders, who hold stocks for a few days or weeks; scalpers, who make tiny, quick trades throughout the day. While trading can be highly profitable, it's also high risk. One bad move, and a trader can wipe out weeks of gains in minutes. What about long-term investors? Long-term investors take a completely different approach. Instead of worrying about daily price movements, they focus on buying strong, fundamentally sound companies and holding onto them for years. This method follows the principles of legendary investors like Warren Buffett, who famously said, "The stock market is a device for transferring money from the impatient to the patient." Long-term investors rely on fundamental analysis, evaluating company financials, growth potential, and industry trends. Dividends, earning passive income from companies that share their profits with investors. Compounding, letting investments grow exponentially over time. While this approach is slower, history shows that long-term investors tend to outperform traders over decades. But does that hold true in the short term? The experiment setup: here's how we'll track our results. KeyCap 1 trader portfolio, buying and selling frequently, using short-term signals. KeyCap 2 investor portfolio, picking 5 strong stocks and holding them for the entire period. KeyCap 3 same starting capital, both begin with an equal amount. KeyCap 4 time frame, we'll track results over several weeks to see real performance differences. Now that we have our strategy in place, it's time to put it into action. Let's dive into the actual trading and investing process to see how they perform. With our two portfolios set, it's time to see how each strategy plays out in real market conditions. The trader's journey: fast, risky, and intense. Our trader starts aggressively. He wakes up early, checks pre-market trends, and scans for stocks with momentum. The plan? Buy low, sell high, quickly. On day 1, he spots a stock that's up 5% in pre-market trading. Thinking it will go higher, he jumps in. Within an hour, it surges another 3%, and he sells for a small profit. So far, so good. By the end of week 1, the trader has made multiple trades, some wins, some losses. While a few stocks moved in his favor, others dropped unexpectedly, leading to quick losses. Trading fees and taxes start to eat into his profits. By week 3, stress levels rise. The trader must stay glued to the screen, analyzing charts and making snap decisions. He makes a big bet on a stock after seeing an upward trend, only for it to crash 10% overnight due to unexpected news. One mistake wipes out several small gains. The long-term investor's experience: slow, steady, and strategic. Meanwhile, the long-term investor takes a completely different approach. On day 1, he carefully researches 5 strong companies with solid financials, competitive advantages, and consistent growth. He diversifies, buying stocks in different industries to reduce risk. By the end of week 1, nothing exciting happens. His portfolio fluctuates slightly, but he remains patient. By week 3, one of his stocks is down 5% due to market noise. But instead of panicking, he remembers, "I'm investing for the long term." He even considers buying more shares while the price is low. Unlike the trader, he isn't constantly checking prices. Instead, he focuses on company earnings reports and long-term business trends. Comparing the results so far at this stage, both strategies have had ups and downs, but the key differences are becoming clear. Strategy effort and stress short-term gains, long-term potential risk trading high, constant monitoring quick profits, but inconsistent. Uncertain, requires frequent wins high, losses can wipe out gains investing low, minimal time spent slow growth strong, builds wealth over time low. Fewer emotional decisions. The trader is feeling the pressure, one wrong move could erase weeks of progress. Meanwhile, the long-term investor remains calm, knowing time is on his side. But which approach will come out ahead? In the next section, we put the audience to the test with a practical challenge before revealing the final results. At this point, we've seen the trader battling market fluctuations, glued to his screen, making rapid decisions, and experiencing both quick wins and painful losses. On the other hand, the long-term investor has remained steady, riding out short-term volatility with patience and confidence. But here's the real question: which strategy makes the most sense for you? Let's put your investing instincts to the test. Your challenge: trader or investor? Imagine you have $10,000 to invest right now. You have 2 options. KeyCap 1: the trading approach. You'll buy and sell stocks daily, trying to time the market for quick profits. This means actively monitoring price movements, using technical indicators, and making multiple trades per week. KeyCap 2: the long-term approach. You'll research and select 5 strong companies, invest equally in them, and hold on to them for at least 5 years, ignoring short-term market noise. Now, take a moment to think. Which path would you choose? Would you prefer the thrill and fast-paced action of trading, knowing that it requires skill, emotional control, and high risk? Or would you rather take the patient and strategic approach, letting time and compounding work in your favor? Speech balloon, drop your answer in the comments. Are you a trader, an investor, or maybe a mix of both? Let's see what the majority of our audience thinks. Key takeaways from the challenge. After reflecting on this, here's something to consider. If you love analyzing charts, handling risk, and making fast decisions, trading might be for you. But it requires deep market knowledge and strong emotional discipline to avoid costly mistakes. If you prefer stability, lower risk, and a hands-off approach, long-term investing is likely a better fit. Historically, it's the strategy that has built the most wealth over time. Rocket Pro tip: many experienced investors use a hybrid strategy. They keep 90% of their money in long-term investments and use 10% for trading or speculative plays. This allows them to participate in short-term opportunities without risking their entire portfolio. Now that you've thought about your own strategy, it's time for the final reveal: who actually made more money in our experiment? After weeks of tracking both strategies, it's time for the final results. Bar graph trader's portfolio. Our trader started strong, making quick wins in the first few days. However, as volatility increased, some losses wiped out gains. Trading fees, emotional stress, and mistimed trades took a toll. By the end of the experiment, his portfolio saw a modest 5% return, but required daily effort and high-risk decisions. Bar graph investor's portfolio. The long-term investor faced little stress and barely checked stock prices daily. Some stocks fluctuated, but the overall trend was positive. By the end of the experiment, his portfolio grew by 8%, without any active trading. Key takeaways: who wins? Short-term trading can generate quick profits, but it's highly unpredictable and requires deep knowledge and discipline. Most traders struggle to maintain consistent gains. Long-term investing builds wealth more steadily, requires less effort, and is backed by historical data showing strong market growth over time. So, who's the real winner? It depends on your personality and risk tolerance. Bullseye final advice: If you want steady, long-term wealth, focus on quality investments and patience. If you're drawn to trading, start small and never risk money you can't afford to lose. Fire, what do you think? Are you more of a trader or a long-term investor? Comment below and let's discuss. And if you enjoyed this experiment, subscribe for more real-world investing insights. Rocket.